Tax schemes for the wealthy aren't just loopholes, they're masterpieces of financial engineering, refined over generations. What started as basic tax avoidance evolved into a sophisticated web of trusts, shell companies, offshore havens, and perfectly legal accounting tricks that make it nearly impossible for billionaires to pay the same percentage as everyday workers. At its core, this system relies on exploiting the tax code's every weakness, shifting wealth in ways that lower tax burdens while keeping assets growing. The early days of taxation were straightforward. In ancient civilizations like Mesopotamia and Rome, rulers taxed land, goods, and labor. As economies became more complex, governments introduced income taxes. The modern U.S. income tax system began in 1913 with the passage of the 16th Amendment, allowing Congress to tax earnings. At first, it only applied to the richest Americans, with rates reaching 77% during World War I to fund the war effort. By the 1950s and 1960s, the wealthiest Americans faced a top income tax rate of 91%, but this did not last. In 1964, President Lyndon B. Johnson signed the Revenue Act, lowering the rate from 91% to 77%. 5 years later, President Richard Nixon further reduced it to 70%. Then came the 1980s, when President Ronald Reagan implemented sweeping tax cuts. The Economic Recovery Tax Act of 1981 slashed the top rate from 70% to 50%, and the Tax Reform Act of 1986 brought it down again to 28%. These changes reshaped how the wealthy approach tax strategy, shifting focus toward investment income and asset management rather than traditional wages. With lower tax rates, wealthy individuals perfected modern schemes, using trusts, shell companies, and tax havens to lower their bills. Billionaires like Jeff Bezos, Michael Bloomberg, Elon Musk, and George Soros have legally paid zero federal income tax in certain years, as revealed in IRS records analyzed by ProPublica. Wealthy individuals borrow against their holdings, extracting cash while avoiding taxable income. Meanwhile, administrations have periodically attempted to crack down on tax avoidance. Franklin D. Roosevelt introduced high tax rates for the wealthy in the 1930s and 1940s to fund the New Deal. Lyndon B. Johnson introduced the Alternative Minimum Tax, AMT, in the 1960s to prevent tax avoidance by the richest Americans. While Ronald Reagan lowered rates in the 1980s, his Tax Reform Act of 1986 did close certain loopholes. More recently, Barack Obama raised capital gains tax rates for the wealthy in the 2010s, and Joe Biden has pushed for higher tax rates and expanded IRS enforcement to crack down on tax evasion. The rise of shell companies and offshore accounts in jurisdictions like the Cayman Islands and Luxembourg widened the tax gap. Despite increasing regulations, the ultra-rich remain ahead of enforcement, restructuring assets to shield wealth from taxation. The richest 400 Americans paid an average federal income tax rate of just 22% between 2013 and 2018, despite earning an average of $268 million annually. Foundations became another key strategy. While they may appear philanthropic, many billionaire-run foundations function as tax shelters, allowing stock contributions to be deducted at full market value while paying only 1.39% excise tax on capital gains. Family offices, private wealth management firms, structure investments to further minimize tax exposure. Today's tax system, at first glance, looks fair. In reality, it has become a finely tuned mechanism where those with the deepest pockets shape laws, structure assets, and deploy financial strategies that keep tax rates absurdly low. Administrations occasionally step in to tighten regulations, but the ultra-rich remain 2 steps ahead, always finding new ways to exploit existing laws while shaping new ones to their advantage. If you want clear, myth-busting tax insights, hit subscribe. Thanks for watching. I'll see you next time.